Hello and welcome to Leviathan News. Today is June 22nd, and we've got the term finance guys on here today. And a bit of a slow news day, but we're gonna make some news here. Term finance is actually here because their auction is wrapping up for one of their fixed term lendings, and so I wanted to bring them on. Actually, fixed lending's really been a um, quite a small industry actually in the crypto space. There's been several protocols that have tried it before with not very much luck, and maybe that's just because like pretty rates went pretty much to zero or like under 1% for borrowing stablecoins over the last year, as everybody was deleveraging. But there has been really an uptick lately with the DAI DSR being raised up to 3.33, and I don't know. So maybe like actual rates coming back is a thing. So welcome, both y'all. So maybe one of you can take. I think it was Dion was going to take the question of like why hasn't fixed rate lending taken off yet? Like why does everybody settle for variable rate lending in crypto?
Yeah, that's a great question, Sam. I think that's actually a pretty common misconception. So it's true that fixed rate lending hasn't really picked up steam in DeFi, but in CeFi, it's been around for.
Oh, of course, yeah. No, well, that's I think everybody knows that. Like if you want to I got a mortgage. I got a 30 rate mortgage with a fixed rate, right? I think everybody knows that. I think that like the question is like in DeFi specifically, you know, it's been tried like uh, for a couple of years now, right? I can name three off the top of my head. So like, why are variable rates just so much more popular?
So, Sam, real quick, I think what Dion was trying to say was
All
that
right.
the demand was already met by centralized
Ah,
things,
right.
and
Oh, okay.
so
Well, I
Dion,
mean,
please continue.
well,
Yeah, to
is
put it
that
in
it?
perspective, if you go back to Q2 of last year,
Mm-hmm.
Genesis and Galaxy Digital combined originated over 80 billion in fixed rate loans backed by crypto in a single quarter. So it was a massive market in CeFi at the peak. That's obviously come down quite a bit since, with Genesis sort of out of the market, Galaxy scaling back significantly. And I think people in that market, are finally starting to realize the significant counterparty risk that they were undertaking by dealing with centralized players, right? When you give your collateral to a CeFi institution, you're putting that collateral in a black box. You don't know what happens to it. And as we saw with Genesis, they ended up lending it unsecured to their parent company, DCG. So, I think because of that, there's renewed interest in trying to do this in DeFi. In DeFi, the collateral is held in smart contract. We've seen that model work very well with floating rate products like Aave and Compound. And those protocols have held up, very robustly in this market, in this bear market, where we've seen ETH and Bitcoin fall over 85, 90% peak to trough, with very limited bad debt. So the model works in DeFi. To answer your question more
But hold on,
specifically.
like, can I retort there? Is that like does it really because you've seen other entrants like Maple was lending out to like several funds that blew up during the Luna crash, and they're now having to claw that back. There's been a couple of other entrants where they're probably shut down by now because they lent out in this more typical CFI way of doing things, and they just never got their money back.
Yeah, they weren't implementing, live liquidations, and collateral wasn't held in smart contract the way it is on Aave and Compound. So I'm referring specifically to the model where collateral is held directly in smart contract and is subject to instant liquidation as soon as it falls below its health factor. With Maple, they kind of had this collateral partially collateralized, not fully collateralized, and it wasn't subject to immediate liquidation if there were any shortfalls. The other problem with Maple specifically is they had a maturity mismatch problem because they allowed the borrowers to borrow on an open-ended term, but were advertising fixed terms to lenders. So what happened was when all the lenders wanted to withdraw their capital, the borrowers were not ready to repay. And so we had a problem where they had to gate the withdrawals, which only worsened the problem on Maple.
you think that's the issue though? Is that the crypto markets, or at least in DeFi, prefer variable rate loans because it gives them optionality on when they can return the funds, like what we see with happening with Aave right now in CRV. So Michael has this fixed rate loan that he's taken through Aave, and he essentially has optionality to pay it back 100 years if he wanted to, if he wanted to keep it that long. And so if he had entered into, say, like a fixed term loan, even for like a 1 year or 5 year or something, I mean, maybe the rates would have been fixed, but he'd have to either like roll it at the end of term, or could be subject to other issues that he doesn't claim it on because of the optionality to it.
Yeah, absolutely. I think with everything in life, there's a trade-off. So with variable rate loans, you have that optionality, but what you give up is that certainty either of return as a lender or being able to lock in your cost of funding as a borrower. And we put out a nice blog post on this where we analyzed Aave floating rate or borrow rates for currencies like Tether and USDC. And you see these spikes around risk events, notably FTX and SVB, where interest rates would spike above 60, 70, 80% for short periods of time. And that really messes up the borrowers. People who are trying to borrow to yield farm, earn a little spread on an LP position. And when it spikes like that, it totally blows up that entire trade. So it's quite uncomfortable having to borrow and be subject to these fluctuating rates that occasionally spike around liquidity crunches. We've heard stories from users about people getting liquidated while they're flying on a plane. Interest rate spikes, they can't get their ledger out to move their position because the Wi-Fi is not good. So this really just allows borrowers to sleep at night. I think another key thing is just because it's fixed does not mean that you do not have optionality. Right, as you see in bond markets, if you need cash, you can sell the bond. Even though you committed to 10 years lending to the government, if you need cash, you sell the 10-year and you get your cash and you can go do what you want with it. So it's not necessarily true that you don't have any optionality. There will be some price fluctuation associated with, the day-to-day movements of the market, but, liquidity is there as well.
Yeah, and I think part of this conversation gets a little murky when we like base our like first principles in DeFi and think like, okay, how do we add tools and add like things to DeFi? Because like if we just take a step back, like in the real world, fixed rate lending is how everything works, right? And like the reason for that is like if I'm a business and I want to go buy like make a capital purchase, right? Like spend money on something that I know is going to make money. Like what businesses are looking for is certainty in like the cost to them. And when you have variable rates, like I used to be a treasury manager for like a real treasury, not a DeFi treasury. And like what you're literally doing there is making sure that on a day-to-day basis, there is actually enough like dollars in your Bank of America bank account to pay the bills that go out that day. And like what you can't build stable businesses on that, or the stable businesses that you can build are incredibly capital inefficient because you need to keep a large amount of cash ready for like moments when interest rates spike, like your costs increase. And like again, staying out of DeFi for one moment, like that is what's happening in the real world with like the Fed interest rates and but basically anyone that's exposed to variable rates right now is like completely screwed, whether you're a mortgage lender or Silicon Valley Bank. And so like I very much believe in order to build like a real economy that actually supports real people, we need to build the tools that like humans need in order to build stable stuff.
Yeah, I think if you take it down to like the personal level, imagine if everybody were on floating rates for the mortgage. Your salary is relatively fixed, but if you don't know what you're paying in mortgage payments next year, that can really throw a screw in your living plans. So people prefer fixed rate mortgages in the US because that offers some security for the homeowners.
And just to interject quickly, I mean, one of the things that we saw, so Dean and I actually met through managing a DAO Treasury, and the goal there was to basically extend the runway of the protocol and basically to be able to fund the development. And one of the things that we saw was really the lack of the ability to lend on a fixed rate basis and be able to project out those future cash flows. So we were really at the mercy of variable rates and so there was really no visibility in how we could manage those cash flows in a predictable way.
Wait, so just to be explicitly clear with what Billy is saying is this is like, it's not just about the cost to borrowers. Like borrowing is always a two-sided market. And like the other side of borrowing is people that are lending money for yield. And a massive, massive problem that we have in DeFi today is that like it's very hard to get like good, high quality fixed rate yield, which means that like these DAOs can't deploy assets into DeFi in order to like generate revenue, like reliably generate revenue to pay operations. And so what this kind of stuff does is not only provide like more tools and like ability for borrowers to build like stable empires, it also gives lenders the ability to like build stable sources of cash flow generation.
That's right.
Yeah, and I think to take it back to your original question, Sam, you know, the reason why I think fixed rates has had trouble gaining traction in DeFi is really due to the existing mechanisms being, you know, pretty inefficient. So to kind of dive into that briefly, as Rex may have touched on a little earlier, existing DeFi fixed rate protocols all primarily rely on the AMM model. So protocols that allow both borrowing and lending, like Yield Protocol or Notional, they rely on AMMs that require LPs to deposit idle capital that sits in the pool waiting for a transaction to show up. In between, they generate no revenue. So the average real return to LPs is about 0.5% per year, right? Not including these token incentives. So it's quite low. And on the borrowing side, the way it works is a borrower deposits collateral into a smart contract. But rather than receiving loan proceeds directly from that transaction, all they get is an ERC20 token, where they have to take the additional step of selling that token into the pool in order to realize any loan proceeds. So it's a two-step process. And in that second step, you know, you incur significant slippage. And then lastly, from the protocol's perspective, because they funnel all loan origination through the pool, the total amount of loans they can originate at any point in time is necessarily capped at the TVL of that pool, right? You can't take out more than what's already in there. Though in practice, given the way the pricing mechanism works, the amount of liquidity at whatever rate you see in the UI is far lower than that. So you'll see in practice, if you try to borrow 2 or 3 million from the pool, the interest rate will go from 4 or 5 to 6 or 7%, right? So it's not scalable at all or any reasonable size. If we look at Compound and Aave, you know, more than 2/3 of that protocol are deposits of, you know, 1 million or greater. So you do need to be able to handle scale if you're going to have a successful growth.
I understand that. I just keep coming back to that
No, please. Sorry.
Oh, I'm just gonna mute Rex for a second. When Rex comes back, we'll turn him on. I guess my issue would be like the fixed rates. So you're dealing with extremely high volatility assets in crypto, right? These things have over 100 volatility, and it just seems strange, right? At least I'm just going to use your guys' example, that the rates that they are at, that somebody would accept that rate for taking on that kind of risk, right? And the one thing that the variable rates do is that they do reprice to what the risk of the market is. And so like, you know, being able to borrow stables against your ETH at 3%, right? I don't know. I mean, is it commensurate with the risk that is being taken there, or is it just that the asset is able to be sold at like into quite depth of a market that it doesn't really matter what volatility the collateral asset is.
So before Dion, you answer, like, I think the important thing to understand for the audience is that, like, with fixed rate lending, slippage has the effect of just reducing or increasing, depending on the side, the interest rate. So if you sell something and you take 2% slippage, like the net result when it's fixed rate is that you can just like kind of remove that from the borrow amount.
What are you talking about, slippage?
So like as Dion was saying, the problem with the old model is that you're selling in and out of an AMM in order to recognize like your loan. But we all know AMM means slippage, right? And
like which part of the AMM?
Okay, just to be clear, did you understand how Dion explained how the old?
I understand how he was talking about notional. But
right, so if you take the loan in notional, essentially what you're doing is taking floating rate, splitting it in half into fixed rate and floating rate, and then selling the half that you don't want. And that's going to incur slippage, which for fixed rate lending, you can think of incurring slippage as just reducing your net interest rate. And that's how you get 3% interest rates dropping down to 0.5% interest rate.
Okay. That wasn't really what I was going on. Yeah, kind of. I mean, I wasn't really like, I was kind of probably taking a step back from notional because, you know, how they're handling their separation of the fixed and floating yields. I'm sure it's like an interesting concept. I was just talking about like the asset risk, right? So typically you're like pricing, you're like pricing your borrow, right, at what you think the risk of default is, right? And I guess like if you guys think the crypto markets are that liquid that you could dump these, you know, 20, 25 million, whatever, how much it is worth of assets into a liquidity pool and not have and be profitable, right? I guess that allows you to lower the rates, or like where do you come up with the rates that are being offered?
Dion, can you explain to us the auction mechanism?
Sure. Let me tackle one at a time.
Yeah.
So to answer the liquidation side, we've seen that model on Compound and Aave. They've been going on for 3 years now through the bear market and haven't had any significant issues with bad debt. So you can think of Aave and Compound as essentially a perpetual loan with varying interest rates, and they have not had any bad debt. Why? First thing is when you borrow against something like Ethereum or wrap Bitcoin, they typically have 125% over collateralization ratio, which means if the value of a collateral falls below 125% of the debt, you'll be instantly liquidated. This is unlike TradFi, where you typically get 24 hours to repay the debt, and then they liquidate after 24 hours. So as long as ETH does not fall more than 25% in a single block time, then the lender will get full recovery. So despite 100% annualized volatility, we just need to ensure that ETH doesn't fall 25% in a single block, because these liquidations will otherwise sell immediately. And so that's why it's been extremely robust and has been able to withstand these massive market moves through FTX, and Terra Luna, and SVB. So, you know, this type of heavily over-collateralized borrowing with instant liquidations, you know, significantly reduces the risk. And that's why people you see on Aave and Compound are willing to lend open-endedly for very low interest rates. And our mechanism is similar to that.
Okay. I mean, I don't think you guys answered the question that I was asking, but I was just wondering about like, how do you guys get to the rates that are being offered?
Sorry. So on that question, you know, if we go back to the existing model, pricing is done through the AMM. The problem there is there's significant slippage. It's not capital efficient. A lot of idle capital has to be tied up to enable that. So what we do is we hold auctions. These auctions match borrowers and lenders, and the interest rate that comes out of this auction is where the borrowers and lenders transact. So it's an auction-determined interest rate. So we let the market determine that. You can go in, you can say, I think the fair price is 5 or 6%, and you'll either make a loan or you won't. You know, the rest of the market will help determine what they think the fair market is.
I'm just looking at your guys' Twitter, and some of the auctions have gone out at like 3% or something like that. Here's one that went for, like, it was Rapsteth borrowing USDC at 3.32%. It's just a little bit strange that, like, that, you know, you could essentially swap into treasuries at 5, right? That the base borrowing rates that crypto borrowers accept is lower than what they can find in treasuries on, like, the short term, right?
Yeah, no, I think that's a really great question. You know, why are people willing to lend on Aave for 2% and borrow at 3.5% when you can lend treasuries at 5.25%? You know,
But I mean, the answer is kind of, I think I'm frozen. 1 second. I think the answer is a little clear, is that, like, there's a lot of money which probably can't exit into those treasury markets and is stuck in crypto land. And so, like, if you've got billions of dollars that are just sitting around, like, what's the safest thing to do with it to earn a yield? Which would be just like, okay, we'll dump it in Aave. Sure, we'll make, 2%, but that's better than nothing, right? Is it?
that's our best guess as well.
Yeah.
And so I think when you are in the DeFi space, lending on an auction like Term, you're going to think, what is my best alternative? And you're going to, participate in the auction, place bids and offers relative to those benchmarks.
Yeah, then it's a little strange that, like, nobody comes along, because you could buy ETH, right, and then hedge it out with some perps on an exchange somewhere, essentially become flat, and then I'm guessing collateralize it somehow through the exchange, right, and then use that to borrow whatever you have, or, like, you could just use or if you have a lot of ETH or something, like, just set up that trade, right, where you're, like, lending to you guys, borrowing at 3%, but then collecting 5 to 10 on the perpetuals, and then also doing some yield farming. I don't know. I mean, there seems like they're, like, the arbitrage, the ability to arbitrage away these low rates should have happened by now, but we're not there yet.
Yeah, I think that's what we're trying to enable. So if you look at that auction that you're referencing, users deposited Rapstake ETH, they're earning anywhere from 4 to 6%, and they just locked in their borrow at 3.3 for some fixed amount of time.
Mm-hmm.
And so they're able to earn that spread of, roughly 2%. And because it's fixed, you can lock in that spread. You don't have to worry about short-term fluctuations in that borrow rate. So you have much more certainty on, what your profit is going to be from this, what we call carry trade. So yeah, that's a great example of, an interesting use case for Term.
Yeah. I guess so what's how's the volumes been for Term so far? I mean, have you guys seen significant demand?
So we've been going through a guarded launch where it's been limited to, partners and friends that have been participating. And so we've been, purposefully capping the amount that people can put into the auctions. But within the first auction, we saw TVL within the contracts reach just under 100,000, and within the second auction that we did, just around the time that USDT was depegging, we had a market where people could put up USDC to borrow USDT. But the volumes that we saw there were relatively modest. I think we cleared about 15,000 worth of loans, as some of our lenders basically got a little bit squeamish about holding USDT for, I think the auction period or the loan term was 2 weeks. So relatively modest sizes there. But yeah, we've just been conducting this guarded launch on ETH mainnet just to basically ensure that the protocol is working as expected, and then looking to launch publicly within the next few weeks.
Interesting. Do you think that, like, DAOs and other on-chain treasuries will be lending through you guys?
I think that'll be second movers. I don't envision DAO treasuries to basically onboard and allow list the term protocol initially until we build out that Lindy effect. I know that's the way that we thought about it. We wanted robust protocols that, had been somewhat battle tested. So I think a majority of our initial users will be, liquid token funds that are, looking to borrow to manage some of these carry trades that Dion was mentioning. Yield farmers that are looking to borrow assets that they're not necessarily looking to hold as core positions to go and yield farm, like in the case of that USDC, USDT market. And then we'll have, yield aggregating protocols or even entities that are aggregating assets for family offices and institutions, and then allocating those across DeFi. And we might have, a few DAO treasuries experiment, but I don't envision they'll be programmatically using the protocol, at least for the first several weeks.
And it'll just, how does it work without like trustlessly? Like, can anybody make an auction? Like, who is the person that like, how is all that controlled?
Yeah, so initially it'll be the protocol. So it'll be limited to the blue chip tokens. On the non-stable side, ETH, wrap stake ETH, and Bitcoin. And on the stablecoin side, USDC, USDT, and maybe DAI, so the majors. Over time, we will probably pass on that decision making to a DAO, when there's a conversion. But in the short term, it'll be limited to the blue chips, primarily for some of the risk factors you touched on briefly before about ensuring sufficient liquidity for liquidations and stuff like that.
Cool. Okay. Well, that's probably a good place to wrap up. And we did have some other DeFi news that kind of goes in with this. I mean, you have MakerDAO, which bought an additional $700 million in U.S. Treasury bonds to boost its holdings to $1.2 billion. Just yesterday, they announced that. So, if this could allow for like on-chain treasuries to access those sorts of rates, maybe there is some like room for growth.
Yeah, it'll be interesting to see with the DAI savings rate getting increased, kind of how that impacts overall DeFi yields, and if we start to see them push up closer to what people are able to earn in U.S. Treasuries. I know there's kind of conflicting views around that, and I've seen, at least some of the people affiliated with Aave kind of just question some of those decisions. So, but I'm kind of interested to see how this experiment plays out.
Why isn't Aave just issuing tokenized positions against those treasuries?
Well, you've seen a lot. I mean, I don't know exactly how much there is in TVL across those tokenized treasuries, but I think it's approaching something like 200 million.
Well, apparently they're about to put in 700 more million.
Yeah, right. I wonder, so from our vantage point, like within TradFi, one of the biggest carry trades is basically posting U.S. Treasuries and then borrowing against that in the repo market. And effectively, what Term is created is an on-chain repo market, where the interest rate that's determined is a result of the auctions that we clear. So, yeah, I mean, this is U.S. Treasuries and traditional finance is one of, if not the highest form of collateral that you can have out there. So onboarding these type of assets into this ecosystem should just spur more interesting and innovative ways to, enhance a robust, mature financial ecosystem.
Especially if we stay in a high interest rate environment.
Yeah, absolutely. Like these aren't degen-y type yields. These are kind of more institutional, buttoned up sort of things.
Except for they are degen-y type, just in the magnitude. Like 2 years ago, saying 5% treasury you would have been considered like an absolute degenerate.
For sure. Yeah, Dion, I'm curious if you have any thoughts on that. Dion's a former government bond trader.
Yeah, no, 5% is juicy. I mean, it's a solid return. I haven't seen this in decades. So,
as one of like the very few people in this industry that is, I'll just say like been a bond trader and like dealt with treasuries. When you see DAI making like very major capital deployments into treasuries, but like specifically off-chain assets, how do you interpret that? And do you think that's like a good thing for DeFi, or is that a centralization risk? Like, how are you interpreting all of these moves?
I think it's great because up till now, crypto has been a game of crypto people making money off each other. It's a closed loop system. So when you start having income come into the ecosystem, that's a good thing because it makes the profits, much more sustainable, right? There's only so much that you can make on new entrants into the space, then getting rugged or losing money in a crash and leaving, that's not really a sustainable model. So we do need to have sustainable yield come into the ecosystem. And by, what DAI is doing is, or MakerDAO is doing is exactly that. They're bringing sustainable yield into the ecosystem, which will ultimately lift all boats.
And just like the parallels within traditional finance, I mean, even within like, there's no kind of isolated or not very many isolated financial markets that exist. So, having these carry trades where, they're increasing the DAI savings rate, but then they're earning 5+% on treasuries. This happens all over the world where, as one country's increasing rates, people are borrowing another currency to go lend in those other markets.
Well, the irony is supposed to be that the higher risk market is supposed to have the higher interest rate, not the lower interest rate. But point taken. I also think that, I guess like to just be like crypto maxi and like FUD maker a little bit. Like, I mean, the counter argument to all this is like, yeah, we're bringing in extra capital and it's not circular anymore. But like, DAI is now kind of at the mercy of probably the US government, but definitely whatever custodian bank is like actually holding these treasuries. And so like I could totally imagine a world where a regulator wants to end DAI and like they can't mess with anything in the EVM and in an immutable way, but they do have like every single bank's by the short ones.
Yeah, they could just freeze those accounts, right?
And so like then suddenly you have like you go from the most pristine collateral that's generating the safest and highest yield to a giant fucking hole. And so is that something that either of you think about as an existential risk, and or is that more just like, if that's the world we're in, like we got a lot bigger problems to worry about?
Well, I mean, you see different protocols. I mean, just to hop in, I mean, like this is why Frax has never done off-chain lending like that.
What? They literally all they talk about is getting the FedMaster account.
Different story. I mean, like, look, the collateral, like the base collateral, like look, that's a different question. That's swapping out the USDC to USD for their own stable coin, which they can earn the interest on, because Circle's making like hand over fist in interest.
Yeah, so sorry, I would just love to get the term guys to respond to that. Do you see that as like an existential risk to DAI or no?
I don't think so. I think there's room for both.
Yeah,
I think there's room for both. I mean, crypto can't be an island, right? We can be an island forever, but then it's not going to be that useful. So we have to connect. But to your point, there will be alternative protocols that pop up that their key differentiator will be that they are not exposed to centralization risk. There will be others that choose to allow for some centralization. And I think we'll ultimately see the whole spectrum of fully decentralized to fully centralized and everything in between. And I think that's healthy, for the ecosystem.
Yeah, I agree with Dion. I think if you think about it just in terms of growing the pie, it's unfortunately or fortunately a necessary evil to embed and extend into, real world assets, including like US dollars and treasuries and, mortgages ultimately, and all these things, to really replace the existing way of conducting financial transactions in a more open, composable, not necessarily entirely fully permissionless across the entire ecosystem, but having pockets of permissionless access, I think is important and critical. But also, many institutions are just never going to be able to play in a compliant way in those environments and ecosystems. So if we're going to build this into the thing that I think we're all trying to strive for, having a hybrid approach is just necessary and important.
Yeah, I mean,
to your point, Rex, I do think that there will always be a corner that will be fully decentralized. So that's sort of the hedge. And I think that should definitely always be there. It's very important to keep that.
Yeah, but I think that's what we're talking about in the whole like DAI matter, right? Is like DAI is supposed to be a fully decentralized stablecoin, but by directly investing into U.S. Treasuries off chain, it now becomes like a on-chain bond fund, right?
I think even more than that, just like accepting USDC was kind of the first.
Yeah, if DAI was ever decentralized, that ship sailed long ago. I mean, we literally call it like runes endgame. Like we're in a dictatorship
Yeah.
and we're calling this decentralized. Like, come on, that's just not what's happening here. And I think that Dion and Billy, what you're saying maybe is that, like, yes, by putting all this money in treasuries, you're incurring risk, but like the flip side of that risk is like you're becoming relevant. And so like I don't know, like we could stay irrelevant all we want and like then no one can ever touch us and like you and me can continue trading back and forth until both of us don't have any money.
I guess my question for you guys would be is like, would you ever launch your own stablecoin? Like why use why use USDT and USDC when you could just have your own stable and arb the rates or like collect all the interest from it and then also arb it if it ever goes below peg?
Yeah, I mean, I'd love to have my own fiat currency as well. It's hard to do. There's quite a bit of legal and regulatory stuff that all of these CBDCs or stablecoin issuers have to handle. We've seen Curve come out with their own stablecoin, and I think they're trying to differentiate themselves from DAI by being fully decentralized, and that's a good thing, as we talked about before. But right now our key focus is on getting this V1 protocol out to market, and then I guess we'll figure out where we go from there.
Yeah, and we're seeing other protocols do the same thing. Like I don't ever want to just like directly compare you to somebody who's also doing like lending, but like Silo Finance is doing the exact same thing where like we're creating lending markets and we're supporting it with our own stable coin, but like first and foremost it's peer-to-peer and like I guess like the point of what I'm trying to say is for term, it's like you bootstrap the market, you build it, and then down the line, if you have the economics to support minting your own stable, like that makes sense because it provides, as Sam, you mentioned, arbitrage opportunities, like minting fees, like all this stuff. But I think it's like much more important to build a protocol that needs a stable coin as opposed to a stable coin and then hope people need it.
Yeah, but I mean, we're talking about debt markets here, honestly. And like you're minting somebody else's debt.
The problem with minting your own stuff for debt markets is people need to want it, and you need to pay for that.
Yeah, but if you can guarantee the peg,
that's a huge if. That's like literally the entire purpose of Frax is to guarantee that.
I understand.
No, I think I get what you're saying, Sam. It's very similar, right? Because when we mint these fixed term, fixed rate tokens, it's almost like a stable coin.
Oh, it is.
There's a day where it matures. The stable coin is just a perpetual loan where you earn zero interest.
Well, no, I mean, but I just want to talk about like money, right? And like money primarily is a form of debt, unless you commoditize it. And so like by issuing debt, you're issuing money. And in your guys' case, you're issuing somebody else's debt, which means that it's like suboptimal ultimately, that there's, you are not able to gain any of the interest income by issuing that debt. And you're also not able to take part in any of the other like benefits that come from it. Obviously, it's a very difficult task, like Rex said. But when we look at these debt markets, this is why Aave is issuing their own stablecoin, right? Is because they can have fixed rate debt issuance at like 1.5%, right? And hold all these assets, right? And they don't have to rely on USDT or USDC anymore because those are like suboptimal in the end, because they're essentially just benefiting a private company, which issues them.
Yeah, no, that's definitely true. I think it's a great business to be a stablecoin. Basically, people are giving you assets, you earn interest, and you pay them nothing. What you give them in return is liquidity. So USDC, Tether, DAI, they've done a great job of creating liquid markets, getting TVL up in their pools. so that the non-interest bearing stablecoin has utility. And the utility is its liquidity. But that is also the hardest part. It takes significant effort to get to a point where your stablecoin has a level of liquidity that is available, in Tether and USDC. It's a great business, absolutely. It takes a lot of effort, and I think that vertical integration you're talking about, owning the entire stack from stablecoin to lending and borrowing, would be a great business model. I think for us, we're new to the game. Our first goal is to get this market up, and then once that's going well, we'll definitely look into how to expand the business. And as you mentioned, that's not a bad direction to go.
Cool. I think it's probably a good place to wrap up on. We're close to the top of the hour. But thank you both for coming on.
Definitely.
Be excited. Wait, when is the guard launch finishing?
Yeah, we're expecting to go to market sometime in mid to late July. So, give us a follow on term_labs. That's where we're going to be posting updates. And then, reach out to the team if there's any additional questions from anyone in the audience. We're happy to dig in any deeper as far as people want to go.
Do you guys have some kind of a Discord or a place where the community assembles and?
Yeah, we have a Telegram chat. We've been relatively quiet in the public Telegram chat of late, but we'll definitely expand that as we go to public launch.
Don't worry, literally everything has been quiet over the last 4 months. I swear it's been grim.
You could have fooled me. We've been heads down trying to get this thing launched. So
sorry. As someone on the content and media side, it has been quiet.
No, but we're really excited what we can bring to the market with Term. We think it's novel. We think it's unique. And there's a lot of other cool things that we can build once we've developed this spot, basically bond market. Where the goal is at one point in the future, we'll have a Term repo token, as we're calling them, maturing every week, every month, say going out to 1 year, and really build out that DeFi native risk-free yield curve, risk-free being the over-collateralization that we touched on earlier. So with that in mind, there's a lot of other cool things that can be built off of that primitive. And so goal one, get spot market up and running, and then see where we can take it from there.
Awesome. Well, thank you for coming on, and we will be back tomorrow. Actually, I think we're going to be back later today. Yes, back later today. Make sure to tune in, and we'll see you soon, Squids.
Thanks for having us on, guys.
Thanks, guys.
Bye.
Thanks for having us.